This is AI Finance Daily. We need to talk about the AI companies getting software margins and the software companies getting AI margins. Historically, software margins have soared high, often reaching 70% to 90% for leading SaaS companies. These incredible figures stem primarily from their ability to scale without a linear increase in costs. However, as AI matures, it reconfigures cost structures. While AI does replace labor inputs, the reality is that many tech companies' margins weren't predominantly derived from labor in the first place. It's crucial to understand that the labor being replaced had little bearing on those high margins. In fact, much of it was support, like customer service or simple data analysis. If we consider how AI fundamentally changes workflows, we begin to see that AI-enabled companies could still struggle to maintain margins. AI systems necessitate substantial computational resources, raising costs significantly. For instance, large language models are notoriously resource-intensive and require robust infrastructure, often pushing margins down, contrary to traditional expectations of profitability around software. In reality, margins for AI compute providers today hover around 30% to 40%. This is where the business model implications become underappreciated. SaaS companies relying heavily on AI technology must rethink their pricing models and operational efficiencies. If AI necessitates reinvestment in infrastructure or additional talent with specialized skills, the margin picture becomes more complex. SaaS firms might transition from pure software as a service models into more technologist-driven services, joining the ranks of IT consulting or custom engineering. Here's why this matters to you specifically. These shifting dynamics influence how investors assess the value of portfolios tied to software companies. Investors often assume that AI adoption leads to a straightforward increase in profitability. Yet they may overlook that software companies integrating AI might sacrifice margins to remain competitive. The number everyone missed is that several leading SaaS companies are currently trading at high multiples, based on outdated margin assumptions. Consider Microsoft. They're pushing into AI aggressively, developing tools like Copilot for Office. Microsoft's margins, traditionally around 60%, could take a hit if AI infrastructure costs outweigh productivity gains. However, the transitional costs are not entirely negative. Companies adopting AI can streamline operations, potentially leading to growth in other areas. Still, this evolution will take time. Nobody's talking about this part. The positive side of these changes is for companies that effectively integrate AI into their existing frameworks. For example, take a mid-tier SaaS player that builds hybrid services. If they can leverage AI for enhanced analytics or user experience without drastically increasing costs, they stand to outperform larger firms stuck in legacy structures. Yet, let's not ignore the risks. AI product development cycles can extend unpredictably, affecting cash flows and profitability forecasts. This is where valuation implications become critical. Investors must reassess SaaS valuations, not just based on historical multiples, but by weighing how AI will shape future margins. The market may need to recalibrate expectations, leading to volatility in stock prices as the realities of AI integration hit home. Now to the personal implications. For investors, understanding this transition is crucial. Are you positioned in funds that focus solely on historical successes? Or do those positions account for evolving market forces? If you remember nothing else from this episode, consider how key players in the market, like Salesforce or Adobe, are reshaping their business models and strategies to incorporate AI efficiently. One scenario is that the mispricing of AI's potential and the associated costs will lead to a reckoning in the investment community. Companies failing to adapt to optimize AI-utilized workflows may see their stock values plummet, while those who champion innovative solutions in product and pricing could emerge as the new leaders. In conclusion, the dynamics of software margins and AI adoption challenge conventional wisdom about growth and profitability. AI introduces a complex, resource-driven cost structure that could hint at declining margins across the board. Understanding this nuanced interplay is essential for navigating the investment landscape, where fortunes will be won and lost based on how well one anticipates these shifts. As AI continues to develop, staying informed is more critical than ever. How will you reassess your investment strategies in light of these changes? AI Finance Daily. Thanks for listening. If this added something to how you think about AI and money, follow the channel.